Hello, good day. How are you? How's your study so far? Why debt equity ratio may vary from firm to firm? How much debt should a firm issue to maximize its value? Well, there's no one theory that can capture everything that drives thousands of corporations' debt versus equity choices. Instead, there are several theories, each more or less helpful, depending on each particular corporation's assets, operations, and circumstances. In this video, we are going to learn four major capital structure theories: the static trade-off theory, the pecking order theory, the signaling theory, and the market timing theory. At the end of this learning session, students should have the ability to discuss critically the theories of capital structure, why a company adopt a particular capital structure, and the impacts. Note that we will explore some scientific and empirical research. Hopefully, this will widen the students' exposure about the theories, how the research objectives and questions are phrased, and what are the key findings. Exposure to journal articles is an important experience at undergraduate level. I hope you will search for the journal articles and read them. Let's start and learn together. For a start, let's refresh our knowledge about sources of financing. What are the three main sources of financing? Have you got the answer? The answer is internal fund, debt, and equity. The first theory in this video is static trade-off theory. The static trade-off theory is accredited to Krauss and Lejeune-Berger, 1973. This theory weighs the benefits and costs of debt. As we have learned, leverage has benefits as well as costs. Take note of the two keywords highlighted in red in the slide. What are the benefits of leverage? Tax saving. What are the costs of leverage? Financial distress or cost of bankruptcy. The static trade-off theory combines the benefits of leverage from tax saving with the cost of financial distress of bankruptcy to determine the amount of debt that a firm should issue to maximize its value. Striving for a balance is the keyword. The static trade-off theory is illustrated in the figure, which plots the value of the firm against the total debt. In the figure, there are three lines corresponding to three different scenarios. The first line in orange color represents Proposition 1 with no taxes. This is a horizontal line. It indicates that the value of the firm is unaffected by its capital structure. The second case, Proposition 1 with corporate taxes, is represented by the upward sloping straight line in blue. The present value of tax shield on debt increases the value of firm. The third line in red color reflects the static trade-off theory. The value of the firm rises to a maximum and then declines beyond that point. The maximum value of the firm is reached as point D asterisk. So this point represents the optimal amount of borrowing. The possibility of financial distress costs reduces the actual firm value. Firm has an incentive to increase leverage to enjoy the tax benefits of debt. But with too much debt, they are more likely to risk default and incur financial distress costs. In other words, firms trade off the returns against the risks. It is about balancing between benefits and costs. According to this theory, the total value of a levered firm equals the value of the firm without leverage plus the present value of the tax saving from debt less the present value of financial distress costs. Let's have a quick check on your understanding. Fill in the blank. The answer is the static trade-off theory attempts to explain the optimal capital structure in terms of the balancing between the benefits of debt, tax shield from interest expense, and the disadvantage of debt, increased expected bankruptcy costs. Next, we are going to learn the second theory on capital structure, the pecking order theory. Before we go into detail about pecking order theory, take note that the followings are key references for the theory. The theory is made popular by Stewart Mayers and Nicholas Maloof in 1984. The pecking order theory suggests that firms have an order of priorities in selecting among alternative forms of financing. This means a hierarchy of financing that begins with retained earnings, followed by debt, and finally new stock issues. When managers want to finance a new project, they will first do so using retained earnings. If internally generated cash is insufficient to fund new investments, then managers will raise external financing through the debt markets. Issuing new equity is their last resort. When two parties in an economic transaction have different information, we say that there is asymmetric information. The pecking order is due to asymmetry or unequal distribution of information in the organization. Who do you think have more information, managers or investors? Well, in the context of capital structure decisions, asymmetric information simply means that managers of the firm generally have more information about company's performance, prospect, and risk than outside creditors or investors. The higher the asymmetry of information, the higher the risk in the company. As creditors and investors have less information about the company, they will demand higher return against the risk taken. The company will have to incur costs to issue debt and equity. This means new equity will have to be undervalued or issued at lower price. Managers will prefer to issue debt to undervalue equity. Equity will be issued only when debt capacity is running out and financial distress threatens. Let's try this quiz. The answer is retained earning, debt, and new equity. Let's read the following statement. Did Miller support the pecking order theory? No, this is because Miller suggests that firms fall into some financing patterns or habits which have no material effect on firm value. The habits may make managers feel better, and since they do not harm, no one cares to stop or change them. The neutral mutations are not immediately embraced. There are two reasons here. First, investors are interested in the firm's financing choice because stock prices change when the choices are announced. Second, the change might be explained as an information effect, assuming that managers have special information. Next, we are going to look into some empirical studies. Farmer and French in 2002 test the dividend and leverage predictions of the trade-off and pecking order models. The research question is, how long-term leverage and dividend payout ratio vary across firms? This slide shows the sample data and model used by Pharma and French. It is good to have some exposure to how empirical research is conducted during the undergraduate study. The findings of Pharma and French study are summarized in this slide. There are 5 key points here. Do you observe such pattern in the real world? To me, the important point is more profitable firms are less levered. Next, we are going to learn the third theory on capital structure, market timing theory. Market timing is an example of behavioral corporate finance. The current theory of capital structure is the cumulative outcome of past attempts to time the equity market. Suppose that investors are sometimes irrationally exuberant, as in the late 1990s, and sometimes irrationally despondent. Firms pay attention to market conditions to decide whether to finance their investment with equity or with debt instruments. If the finance manager's views are more stable than investors, then he or she can take advantage by issuing shares when the stock price is too high and switching to debt when the price is too low. Firms chooses the form of financing which at that point in time seems to be more valued by financial markets. Market timing could explain why companies tend to issue shares after running ups in stock prices, and also why aggregate stock issues are concentrated in bull markets and fall sharply in bear markets. Next, we are going to look into some empirical studies. When would firms issue new shares or repurchase own shares? According to the study of Baker and Vogler in 2002, firms issue new shares when they perceive they are overvalued, high price, and firms repurchase own shares when they consider this to be undervalued or low price. A hot market IPO is a highly anticipated first-time issuance of a company shares to the general public in an open market. It appeals to many investors. There is an elevated demand, and the demand for shares even surpasses the initial supply of shares. If a hot IPO is underpriced, it will likely see its stock price rise after the shares begin trading. If the IPO is overpriced, the stock price will likely drop. The research by Alti in 2006 shows that hot market IPO firms issue substantially more equity and lower their leverage ratios by more than cold market firms do. The fourth capital structure theory is signaling theory. What is meant by signaling? Signaling means one party conveys some information about itself to another party. Read the following assumption. Is this assumption realistic? When making capital decisions, a company's management should have more information than an investor, which implies asymmetric information. As managers know far more about the firm's performance and prospect than outsiders, they are unlikely to issue shares when they believe shares are undervalued, but more inclined to issue shares when they believe they are overvalued. In the face of asymmetrical information in financial markets, outside investors must rely on firms' actions in order to gain information known only to firm insiders. Such actions can be construed as signals of firm quality. Capital structure can serve as one such signal. Consider the following cases. What is your answer? I'm sure you have your own insights. According to Rose 1977, the values of firms will rise with leverage, since increasing leverage increases the market's perception of value. It's quiz time again. Let's fill in the blank. The answer is a firm's stock price should rise when it issues debt. A firm's stock price should fall when it issues equity. Next, we are going to look into some empirical studies. Mayer and Malouf 1984 studied the issue invest decision when the firm's managers have superior information. According to finance theory, firm would evaluate investment opportunity and take every positive net present value project, regardless of whether internal or external funds are used to pay for it. The research question is, what if the firm's managers know more about the value of its assets and opportunities than outside investors do? The findings show the tendency of corporate to rely on internal sources of fund and to prefer debt to equity if external financing is required. Management will act in the interest of the old stockholders and will refuse to issue shares, even if it means passing up a good investment opportunity. When managers have superior information and stock is issued to finance investment, stock price will fall, other things equal. This action is nevertheless in the existing stockholders' interest. If the firms issue safe debts to finance investment, stock price will not fall. To conclude, asymmetric information affects firms' issue invest decisions. What is debt-reducing exchange offers? It is an offer to exchange common stock or preferred stock for outstanding debts. Little or no cash changes hands, and the asset structure of the firm is essentially unchanged. Lai, and McConnell in 2001 asked two research questions. First, why do firms undertake debt-reducing exchange offers? Second, what is the information conveyed by such offers? Debt-reducing exchange offers are undertaken by financially weak firms in an effort to stave off further financial distress and thereby preserve value for shareholders. Announcement of debt restructuring exchange offers apparently contain two pieces of information. First, the firm is financially weaker than would have apparent from other publicly available information. Second, the management is attempting to preserve value for shareholders. So, what is the impact of debt-reducing exchange offers on share price? Well, announcement of debt-reducing exchange offers are associated with a negative average stock price reaction. Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you, see you and goodbye.